Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. We've got a stack of Bloomberg articles today, spanning energy, tech, and even some international political intrigue. Buckle up, because we're diving deep into the news that could shape your week ahead.
Yeah, let's kick things off with a story that's generating a lot of buzz. President Biden's last-minute decision to ban offshore oil drilling in vast stretches of U.S. waters. Bloomberg is calling it a parting shot aimed at the incoming Trump administration.
Okay, so this ban covers over 625 million acres. That's huge. What's the real impact here? Is this just symbolic, or could it have lasting consequences?
Well, it's certainly a bold move by Biden, especially considering it comes just 2 weeks before Trump takes office. The ban targets areas along the east and west coasts, the eastern Gulf of Mexico, and the northern Bering Sea, citing environmental risks and minimal fossil fuel potential. But what's interesting is that it doesn't affect existing leases or future sales in certain areas, like Alaska's Cook Inlet and parts of the Gulf of Mexico.
So it's strategic. But Trump's team isn't exactly thrilled, calling it a disgraceful decision and vowing to drill, baby, drill, once they're in power. Bloomberg even suggests that this could be harder for Trump to reverse than other Biden actions because it's based on a law from 1953.
That's right. It gives presidents broad authority to withdraw waters from leasing. But remember, Trump himself withdrew some of these same areas from drilling back in 2020 during his campaign. Of course, those protections were set to expire, while Biden is making them permanent. It's a fascinating political chess match.
And of course, the oil industry is weighing in, arguing that this ban undermines domestic energy potential, especially considering what's happening globally, like the ongoing war in Ukraine. They feel like it limits our options.
Yeah, their concerns are valid. We're seeing a renewed focus on energy security, and the U.S. has the potential to be a major player. But we also can't ignore the environmental risks. Bloomberg reminds us of the devastating Deepwater Horizon disaster in 2010, which really highlighted the potential consequences of offshore drilling. It's a complex issue with no easy answers.
Definitely a lot to unpack there. Biden's emphasizing environmental protection and energy security, while Trump's team accuses him of playing politics. It's a classic clash of priorities. What do you think is the most important takeaway for our listener as this story unfolds?
I think it's about understanding the broader context. This isn't just about drilling for oil. It's about weighing economic interests against environmental concerns and navigating the delicate balance between domestic energy production and reliance on foreign sources. It's a conversation that will continue long after Biden leaves office.
Okay, let's shift gears now and talk about something that's always generating headlines: Bitcoin. Bloomberg's reporting that Bitcoin is approaching $100,000 again, and they're linking it directly to Trump's upcoming inauguration.
It's fascinating to see how political events can move the crypto markets. There's a sense of optimism among Bitcoin enthusiasts that a Trump presidency will create a more favorable environment for cryptocurrencies. We saw this play out last year when Bitcoin's record rally started to lose steam in December. Now, with Trump's victory set to be certified, investors seem to be jumping back in.
Bloomberg highlights a surge in investment into U.S. Bitcoin ETFs, which is in stark contrast to the record outflows we saw in December. They even mentioned something called the Bitcoin Coinbase Premium, which, for those who don't know, is basically a measure of U.S. investor demand. And guess what? It's recovering nicely.
It certainly points to a bullish sentiment brewing, but it's important to note that not everyone is convinced this rally is sustainable. Bloomberg cites an MLIV Pulse survey, where a significant number of experts predict Bitcoin will actually end 2025 with a loss. So there's a healthy dose of skepticism out there.
Right, a classic case of bulls versus bears. And let's not forget about Trump's past statements on crypto, including his idea of creating a national Bitcoin stockpile. Bloomberg's reminding us of these pledges and raising the question of whether he'll actually follow through.
That's the million-dollar question. Trump's known for his unpredictable moves, so it's hard to say what his crypto policies will look like in practice. It's a wild card that investors will be watching closely.
Speaking of wild cards, let's dive into another intriguing headline from Bloomberg. BlackRock's Bitcoin ETF posts highest outflow after banner year. This one seems a bit counterintuitive considering the Bitcoin rally we just talked about.
It is a bit surprising on the surface. BlackRock's iShares Bitcoin Trust, which happens to be the largest spot Bitcoin ETF, just experienced its highest daily outflow ever, a whopping $333 million. And this comes after a year of record inflows.
So what's going on here? Is this a sign that institutional investors are losing faith in Bitcoin?
Not necessarily. Bloomberg suggests this might be more of a temporary blip than a major shift. Experts they spoke to attribute the outflow to institutions managing year-end risk and making adjustments to their balance sheets. It's not uncommon to see these types of moves at the end of a year.
Okay, so maybe not time to panic just yet.
Yeah.
But Bloomberg does mention a drop in open interest for Bitcoin futures on the CME, which is another indicator that institutional interest might be cooling off a bit. What should our listener make of this?
I think it's a reminder that the crypto market is incredibly volatile. Even with institutional players like BlackRock involved, things can change quickly. It's important to stay informed, do your research, and understand that crypto investments carry inherent risks.
Now let's turn our attention north of the border. Bloomberg is reporting that Canadian Prime Minister Justin Trudeau is expected to resign this week. And it seems like his clashes with former Finance Minister Chrystia Freeland are at the heart of it.
According to the Globe and Mail, which Bloomberg cites in their article, the pressure on Trudeau to step down has been mounting following Freeland's departure and growing concerns about the potential impact of a Trump presidency on Canada's economy. There's talk of potential U.S. tariffs on Canadian imports, and that's adding to the uncertainty.
So how's this playing out in the markets?
Well, the Canadian dollar initially strengthened after the report of Trudeau's potential resignation, but it remains weak overall. Bloomberg points out that investors are closely watching to see who might emerge as a successor.
They mentioned Freeland as a possibility, along with Mark Carney, who's a familiar name in financial circles. He's the former governor of both the Bank of Canada and the Bank of England. Talk about an impressive resume.
It's certainly a crucial time for Canada. They're facing political uncertainty at home and potential economic headwinds from the U.S. The next few weeks will be very telling.
All right, before we wrap up this first part of our deep dive, let's do a quick rundown of some other noteworthy headlines from Bloomberg. First up, JetBlue has been hit with a $2 million fine by the DOT for chronically delayed flights, the first penalty of its kind.
It seems like the DOT is cracking down on airlines for unrealistic. It's a currency tug of war. And it'll be interesting to see how this plays out in the coming weeks. Now over in Europe, markets opened higher, with chip firms like ASML leading the way after strong revenue reports from Foxconn. It seems like tech is still a driving force in the markets.
And finally, gold prices rose slightly. But Goldman Sachs has lowered its forecast for the precious metal, no longer predicting it will reach $3,000 an ounce by year-end.
It's a reminder that even safe haven assets like gold can be susceptible to market fluctuations.
We've got a lot more ground to cover, including some fascinating M&A activity in the Japanese market and a deep dive into the latest mortgage rate trends. But we'll save those for the next part of our deep dive. Stay tuned, folks. We'll be back in a flash.
Sounds good. Welcome back to part 2 of our deep dive into the latest financial headlines. We're picking up where we left off with a closer look at some intriguing stories that could have a direct impact on your wallet.
You know, when we talk about things hitting close to home, this Market Watch headline about mortgage rates definitely qualifies. Mortgage rates inch up to start the year at a near 6-month high. Ouch. What's the latest on this, and what does it mean for anyone thinking about buying or selling a house?
Well, according to Freddie Mac, the average 30-year fixed-rate mortgage has climbed to 6.91%, its highest point in almost half a year. This follows a trend we've been seeing for a while now, and it's making affordability a real challenge in the housing market.
6.91%. That's a far cry from the super low rates people were snagging a few years ago. The article mentions this lock-in effect, where current homeowners with those incredibly low rates are hesitant to sell because they don't want to get hit with a much higher rate on a new mortgage. It makes sense, but it kind of creates a logjam, doesn't it?
Exactly. It's making it tough for those looking to enter the market or even move up to a bigger place. High interest rates combined with record-high home prices are creating a bit of a gridlock, but there's a glimmer of hope on the horizon.
Tell me there's some good news in here somewhere.
Both consumers and industry experts are predicting that mortgage rates will actually fall in 2025. Fannie Mae even reported that a record number of consumers are expecting a decline. If that happens, it could really re-energize the housing market.
Let's hope those predictions pan out. But even if rates do drop, the article cautions that the road to affordability might be bumpy. What's your take on that? What should our listener be prepared for?
I think the key takeaway is patience. Whether you're a buyer or a seller, don't rush into any decisions. Stay informed about market trends, do your research, and be prepared for some fluctuations along the way. There are a lot of factors at play, and things can change quickly.
All right, let's move on to the energy markets. CNBC is reporting that oil hovers at highest since October on cold weather, China stimulus. A double whammy boosting oil prices, it seems.
It's interesting how these global events can converge and impact something as fundamental as oil prices. We've got the colder weather in the northern hemisphere driving up demand for heating oil. And at the same time, China's economic stimulus measures are injecting optimism into the market.
And let's not forget, China is the world's biggest oil importer, so their actions have a ripple effect across the globe. The article mentions that they're increasing funding for infrastructure and consumer-boosting initiatives, which will likely lead to even higher demand for oil.
That's right. And then on the supply side, we've got Goldman Sachs predicting a decline in Iran's oil production and exports due to potential policy changes and tighter sanctions under the incoming Trump administration. That could further tighten the market and push prices upward.
So we've got increasing demand and potentially shrinking supply. What does this all mean for our listener? What should they be watching for?
I think the most immediate impact will be felt at the gas pump. Higher oil prices tend to translate into higher gas prices, so that's something to keep an eye on. But it goes beyond that. Rising oil prices can have a cascading effect on the cost of goods and services, impacting everything from transportation costs to the price of groceries.
It's all interconnected, isn't it? Okay, let's dive back into the stock market. Bloomberg's Stock Market Today update has tech stocks back in the spotlight.
It seems like tech is regaining its momentum after a bit of a year-end correction. Microsoft's announcement that they're planning to spend a massive $80 billion on data centers has sparked optimism about the future of artificial intelligence infrastructure. Investors are clearly excited about the potential growth in that area.
And NVIDIA, the AI chip darling, is seeing its stock price soar in pre-market trading. The article also mentions strong revenue growth from Hanhai Precision Industry, NVIDIA's Taiwanese partner, all positive signs for the tech sector.
It seems like investors are regaining confidence in the growth potential of these companies that are leading the AI revolution. It's a trend worth following closely.
Now let's inject a note of caution into this tech enthusiasm. MarketWatch has a piece titled Stock Market Manages Strong Start to 2025. But watch for these potential pitfalls. What are they warning us about?
They're highlighting that while the U.S. stock market has had a solid start to the year, both the S&P 500 and the Nasdaq Composite posted their best opening gains since 2018. But there are some potential headwinds to be aware of.
Okay, let's talk about those headwinds. What should investors be on the lookout for?
One of the key concerns is the health of the U.S. labor market. The article suggests that the jobs market might not be as strong as the official data indicates. They point to some discrepancies between the non-farm payroll numbers and data from other sources, like the Institute for Supply Management's Manufacturing Index.
So maybe a bit of a disconnect between the data and the reality on the ground.
That's what the article is suggesting. They also raise concerns about the impact of the gig economy on jobless claims data, arguing that it might be masking the true extent of unemployment. It's a reminder that we need to look beyond the headlines and really dig into the data to get a clear picture of what's happening in the economy.
It's a good reminder that the stock market doesn't always perfectly reflect the underlying economic conditions. What's the key takeaway for our listener here?
I think the most important message is to be cautious and do your due diligence. Don't get swept up in short-term market fluctuations. Focus on your long-term investment goals and stay informed about the factors that could impact your portfolio.
All right, before we move on to the final part of our deep dive, let's take a quick detour into the world of sports betting. MarketWatch has a piece about DraftKings launching a new subscription service that's raising eyebrows.
They're calling it DraftKings Sportsbook Plus, and it's essentially a premium service for more serious bettors. For a monthly fee of $20, members get what DraftKings calls stepped-up boosts on all parlay bets.
So they're offering better odds to subscribers, but parlays are notoriously difficult to win. Isn't this a bit of a risky proposition for DraftKings?
It is a calculated gamble. Parlays, where you combine multiple bets into one, are a big moneymaker for sportsbooks because they have a low probability of winning. By offering slightly better odds to subscribers, DraftKings is hoping to entice more people to play parlays, ultimately increasing their own profits.
So they're betting on volume, essentially. It's a fascinating insight into the business side of sports betting. What's the main takeaway for our listener here?
I think the most important thing is to be aware of the dynamics at play. Parlays can be tempting, but the odds are stacked against you. Gamble responsibly, understand the risks involved, and remember that it's ultimately a form of entertainment.
Excellent advice. We've covered a lot of ground in this second part of our deep dive. Housing, energy, the stock market, and even a peek into the world of sports betting. We've got one more segment coming up where we'll explore some M&A activity in Japan and unpack the latest news on inflation. Stay with us, folks. There's more to come.
Welcome back to the final stretch of our Monday morning deep dive. We've analyzed energy markets, navigated the choppy waters of Bitcoin, and even taken a gamble on the latest trends in sports betting. But we're not done yet. We've got a few more intriguing stories to unpack before we set you loose on your week.
Let's hop over to Japan, where Bloomberg is reporting on a surprising acquisition that's shaking things up in the home appliance industry. Get this. A Japanese oven maker is buying out Fujitsu General, the air conditioner unit of the tech giant Fujitsu, for a cool $1.6 billion. Wait, an oven maker buying an air conditioner company? That seems like an odd pairing. What's the strategy here?
It might seem strange at first glance, but there's actually some interesting synergy at play. The company making the acquisition is Paloma Ream Holdings, and they're known for their oven ranges and water heaters. Bloomberg points out that they've already collaborated with Fujitsu General on developing air conditioners for the North American market.
So they're not complete strangers. But it's still a bold move for a company that's primarily known for kitchen appliances.
It definitely signals their ambition to expand beyond their core business. This acquisition gives them a foothold in a new market and diversifies their product portfolio. But there's another layer to this story. Bloomberg highlights that this is part of a broader trend of Fujitsu divesting non-core assets. They're streamlining their operations and focusing on their IT business.
So it's a win-win. Paloma Ream gets to expand and Fujitsu gets to sharpen its focus.
That seems to be the case. It's a reminder that even in mature industries like home appliances, there's still room for disruption and strategic maneuvering. It'll be interesting to see how this acquisition plays out in the long run.
All right, before we wrap things up, let's touch on one more crucial topic that's on everyone's mind: inflation. MarketWatch has a piece titled, "Inflation Cools Further, but it may not be enough for the Fed to cut rates." What's the latest on this economic roller coaster?
The good news is that inflation continues to ease. The Consumer Price Index, which is a key measure of inflation, rose just 0.2% in December, according to the Labor Department. That's a slowdown from the previous month.
So things are heading in the right direction. But the article suggests the Federal Reserve might not be ready to hit the brakes on interest rate hikes just yet. Why is that?
Well, while inflation is cooling, it's still above the Fed's target of 2%. The article explains that the Fed wants to see more sustained progress on bringing inflation down before they consider pivoting on their monetary policy.
So they're proceeding with caution. What's the key takeaway for our listener as they navigate this uncertain economic landscape?
I think the most important thing is to stay informed and be prepared for continued volatility. Inflation, interest rates, and economic growth are all interconnected, and they can impact your personal finances in various ways. Pay attention to how these trends are developing and make adjustments to your financial plans accordingly.
Solid advice. Well, that brings us to the end of our Monday morning deep dive. We've covered a lot of ground today, from the political maneuvering surrounding offshore oil drilling to the unexpected moves in the Japanese appliance market. It's been a whirlwind tour of the financial world, and hopefully you're feeling a bit more informed and prepared to tackle the week ahead.
Remember, staying informed is your best defense against uncertainty. Keep asking questions, keep digging deeper, and never stop learning. The more you understand about the forces shaping the financial markets, the better equipped you'll be to make smart decisions for yourself and your investments.
Couldn't have said it better myself. We'll be back tomorrow morning with a fresh batch of headlines and insights from the world of finance. Until then, stay curious, stay informed, and have a fantastic week. We'll see you all tomorrow morning with new headlines from major financial magazines.